about $1.5 billion in assets under management. Well, with that exposure, with those assets, this volatility must be exhausting, Nancy.
Oh, yes, it's been a roller coaster ride. I think the market's been trying to find its bottom. But, in my profession, where I'm in the business of meeting clients' long-term goals, the day-to-day, it really doesn't matter. What really matters is the longer term. And that's what people have to adjust themselves. They have to resign themselves to the fact that we will continue to have this kind of volatility, and it's not over until it's over. And the signs of it becoming over are just barely beginning to show up now. It's in the labor market, the payroll, and by the way, I know how much you like bonds. I think it's getting very close to being a bond bull market, but not quite yet. But we're like weeks away from that.
Yeah, I mean, look, Nancy, it does look like we're potentially headed there. And I think you make a good point here, not necessarily focus, at least for you and your clients, on the day-to-day, but the long term. And right now, most people, at least the day-to-day traders, are betting that the long term is going to be a persistently higher Fed funds rate, a persistently higher, of course, Treasury rate as a result. And, of course, that means valuations on everything else have to adjust to that as well. Is there an adjustment already taking place by you and some of your clients?
Absolutely. I think I actually believe, and maybe I could be wrong about this, but I actually believe Mr. Powell when he says he's going to continue to raise rates in November and in December, and get to a certain level before they take a pause, as he called it, to see what the effects are. I do believe that that will happen, but I also believe that the market's already priced all that in. In fact, I think the market may have even priced a recession in, which is almost inevitable at this point in 2023. But I would still err on the side of caution and be very prepared for more bumpiness along the way. This is not going to be a smooth ride.
If things have become priced in and if everything seems that it's going to deteriorate, do you wait longer? Do you decide actually that now is a decent time to start putting money to work? You might not be calling the bottom, but you're getting near it.
Yeah, trying to time the market is really not a good approach to investing. If you have long-term goals that are at least 4 or 5 years or longer, this is a great entry point. I mean, the market's down 25%. That's a pretty good deal in my book. And if you're in it for the long term, you're going to be just fine. But if you're trying to time when the bottom is, you could actually lose. The risk is higher because when the run-up occurs, it goes very quickly.
Nancy, and when we talk about the potential for a recession risk, I mean, we should point out the Bloomberg economics model actually now predicting a 100% chance of a recession into next year. And we've heard from Citigroup and a few other major banks here in the U.S. basically saying that a recession is basically a lock based on the market pricing that they're looked at. That's the U.S. story. I am curious about the European story, not only whether they're headed for a recession, but whether you see any opportunity over there for some of your clients to maybe find, if not bargains, at least opportunity.
Yeah, I think that the international market is very, very difficult right now. They are definitely, in my opinion, heading for a recession, if not already there. And they're really struggling with the whole Ukraine-Russia war and the supply of energy and the cost of the energy and maybe even a shortage. And then even if you find some glimpses of opportunity, by the time you convert to the currency, the U.S. currency, you're barely even, if still not negative. So I think it's a very, very difficult play at this time when there's so much more opportunity to be had in the U.S. Side. However, having said that, a few months down the road and perhaps by mid-year next year, there will be significant upside opportunity in Western Europe as well.
Okay, so bide your time on Europe. Now is perhaps not a bad time to be putting money to work here in the U.S. Where then within, say, equities, you're saying already we're heading towards, in fixed income, some sort of a ripe opportunity. But within equities, are you looking at maybe the battered down growth stocks that now have a valuation that's attractive, or is it more just riding out for cyclicals at the moment?
So again, it all has to do with time frame. I think the safer bet are income stocks. Anything that is mid cap or large cap value would probably be a good opportunity. But being an opportunist, I always go for, well, what's been beaten up the most? And that's certainly information technology. I mean, that's taken such a big beating. And if you're in it for the long term, this is going to be a great payday. Energy certainly, and alternative energy is a grand opportunity as well. Financials have taken a beating more recently, so that could be a grand opportunity. So it really has to do with the individual investors' time frame and risk tolerance, and what their preferences are.